I'm delighted now to be joined by Mark DesJardine, Associate Professor at Penn State University.
Great to be here, Richard.
Before we get into the detail on that, can we just cover a few basics for those who aren't familiar with this space? What is hedge fund activism? How does it work? How prevalent is it today?
Hedge fund activism works by, we've seen this if you're following the news with Danone and with Exxon and Engine Number One, by taking a stake. And in the case of Engine Number One, can be a very small stake, tens of millions of dollars of capital, 0.02%, I think they had, of Exxon. And you're leveraging that stake to convince other investors that the current strategy, the current management, or current governance of the target company isn't maximizing shareholder value. Over what time frame, we can talk about that too, and using that to sort of increase and leverage control of the company. And how so that's how it works. How prevalent is it? It's very prevalent. We saw a dip after the 2008-09 global financial crisis, but now I was looking this quarter of this year, and we had little slowdown with COVID. There were like 250 activist demands around the world focused on financial matters. About half of those were by hedge funds. We're seeing new hedge funds pop up. And I think the two things that CEOs, managers want to be aware of, and investors want to be aware of, is that we're seeing it now spread way beyond the US. It's always been there, but now in a big case going global. Seeing companies in new countries be targeted, and then the largest companies now, where 10, 15 years ago those were very rare, but now it's any company can be a target.
So you mentioned, obviously, for a hedge fund activist to be successful, they have to convince other investors to get behind whatever they want to do. So is there a sense in which companies that are subject to successful attacks kind of have it coming, right? Because when Unilever was subject to a hostile takeover bid back in 2017, that was unsuccessful because Unilever's investors kind of said to the activists, actually, we believe in the long-term strategy of the business. We believe it's going to create value for us over the long term. So jog on, we're not interested in your agenda. That, whereas the more recent stories at Danone, which you referenced, and I think we should get into that a bit more, but also at Exxon, in those instances, the activists have convinced a lot of those companies' existing investors to get behind their agenda.
Yeah, there's odd cases too where an activist can actually take a bigger ownership stake, and so it depends on fewer investors, or Wolfpack, a group Danone. We saw 2-3 activists coordinating there to get that message going and to support one another. But you're right? It does depend on, even in settlements and in proxies. A settlement is a reflection of when managers are settling with the activists to come to terms. The middle, that's a reflection that the investor sentiment is also on the side of the activist hedge fund. So in both cases. But you're right, it does depend on other investors, and that's part, we're just talking about Acciona and that transformation, and with Neste before that, and these companies that are doing this, they have to maintain very close pulse on their investors of who they are, the support there, because if an activist hedge fund can come in and change that tide and realize that the investor sentiment is sort of moving a different way, and that the values of those shareholders, and I say values because even financial, social, environmental, but also long-term or short-term financial value, the activist hedge fund can leverage existing investors against the management, then that's not going to end well for the company.
You've also done research that seems to show that very often hedge fund activism destroys long-term value. How clear-cut is the evidence for that? Because I know that there are other studies out there that put a more positive spin on the impact that hedge funds have in going after companies that are failing and turning them around, at least for a period of time. So can you talk a little bit about what your research has shown there?
I come from investor relations. I'm a CFA charter. I come from finance, and so I follow the discussions in academic research and in finance. Even though I'm more of a strategy sustainability scholar. And you had 20 years of finance studies looking at sort of, not to make it too complicated, but stock prices, event studies, looking at a company's stock price in the 10 days around a hedge fund activism campaign and saying, well, look, it spikes up to 10%, 20%, 30%. And that's great. That's value enhancing. And so what I did is created, looked at 20 years of data, created a match sample, 1,600 target company cases, and found that when we expand that window up to 5 years, you still see that 10% rise in, the first year, and then it starts to, fizzle a bit in the second year. And keep in mind, the average activist hedge fund here, investment window, around 13 months up to 2 years, some are different. But then 3, 4, 5 years out, excuse me, you're seeing that complete reversal where actually value has been destroyed in the long term, on average. So I'm not saying every case works out, of course not this way, but on average, when you look across the past 20 years of those cases, that financial value 5 years out is destroyed. And that's what I think should concern other investors. That's when we look at Danone. What's the fate of Danone if we change this company? Where is it going to be? Or other cases.
Can we talk a little bit about engine number one and Exxon and what happened there? So this is you've been referencing primarily the negative impacts that hedge funds have from a sustainability and long-term perspective. But here we saw, as you said, a new hedge fund that took a very small stake in a very powerful fossil fuel major and has successfully got, I think, is it 3 seats on the board now for new board members who have serious experience about climate change, climate strategy, and will be influencing Exxon's strategy accordingly. That seems like a very positive story. Is that a total anomaly in the marketplace at the moment, or do you see that as the beginning of a new trend in positive hedge fund activism?
Seeing these players as getting the ball rolling, the momentum going, and not, making that whole transformation happen themselves. I think we have to keep in perspective of the role of activist hedge funds and what they're doing as we think about what the hope here is for engine number one and other hedge funds. It's not a total anomaly. I mean, I would reference, it's certain, I think there are 5 ESG activist funds started last year, maybe off by a couple. One was by Jeff Ubben, who came out of Value Act and started Inclusive Capital Partners. That's very similar, little different strategies, but it's an ENS, I would say, activist hedge fund. So it's not a total anomaly. I mean, it was rare, and it was interesting to watch what they were able to do with such a small stake, because you're right, engine number one is a tiny activist hedge fund when we think about the size and the scale of others and of Exxon, who they were going after. Exxon could hike its dividend this year, and that could raise the stock price 45%. And for me, I have a PhD in strategy. It doesn't take a PhD in strategy to figure that out. You're trying to transform a company, a massive company, on this renewable energy path, and you're talking about hiking the dividend and taking capital out of the company. And for me, that's a huge mismatch. Activist hedge funds love dividend increases, and they love share buybacks because that increases the stock price. It's an immediate payoff, and that's sort of the classic move. But for me, that classic move doesn't make a lot of sense here. We think of this, what they're trying to do at Exxon.
Why do we need hedge funds exactly? Are they, if the goal is a sustainable economy in the future, do we need hedge funds for that? Are they part of a healthy ecosystem?
Activist hedge funds are the sort of single biggest threat in financial markets to CEOs who waste shareholder capital, who don't, that there's a great wall between investors sitting in their office and CEOs sitting in their office with shareholder capital. And we know, many theories, many studies showing that managers can go astray. And so activist hedge funds can sort of keep CEOs' eyes and managers' eyes on the ball. But what that ball is debatable, and that's moving. And that's, now I think we're at a point where maybe the pendulum swung too far one way, and we're seeing cases where activist hedge funds, what I've shown, can destroy a lot of value. But that's, there's a tension there, but there's a role to play.
And so I guess that brings us to the question of whose responsibility is it to fix this? So we just had a question in from Fiona about, what do we think? What could other business leaders do to speak out and challenge this pattern of short-term activist investment? So there's business leaders could speak out. I know when we last spoke a couple of weeks ago, you mentioned, you're spending your time now often talking to institutional investors, and is there a case to be made that if it's a a pension fund, for example, that should have a very long-term mindset, should they not be allocating funds to a hedge fund that is engaging in short-term activism that may be destroying long-term value? So is it up to the investors? Is there something business leaders can do to call it out, or is this something for lawmakers and regulators to get stuck into?
I mean, boy, that's a big question. It's a good question. And I mean, the short answer is that it's going to take a lot of different forces to sort of rebalance this and to ensure that, investors with short-term financial interests can't destroy companies. They can't. I'm not saying that's what's going to happen at Danone, but there's a lot of questions there about, that derails a company like that has a broader purpose. Part of it, we need to be aware at the individual level. I mean, there's a whole bunch of people on this meeting right now that pension funds have been one of the biggest drivers of activist hedge fund growth, of funding in the past decade or so. And, a lot of us hold the pension funds. And so actually that makes us those investors through our pension funds, through these activist hedge funds. So we need to be aware of where we're invested. I was talking to about 80, 90 pension fund managers a couple of months ago, and they said, well, they like the diversification benefit. Activist hedge funds make sense because it diversifies the portfolio. When the market's down, they can still get that value. Like, well, look who you're managing for, right? Look at your broader duty here and what you're doing. And it can't all just boil down to, diversification or short-term performance, portfolio performance.
Thank you, Mark, very much for taking the time to share your insights on this with us, and looking forward to continuing the conversation and to seeing the next bit of research you publish.